Despite what you may have heard, it is not the Federal Reserve who actually controls interest rates. There are two main things the Federal Reserve controls in order to enact its monetary policy. And the first one is this, which is the federal funds rate. And the second is this, which is the Federal Reserve's balance sheet. So despite all the excitement or the hope that many people are experiencing right now that mortgage rates will be coming down soon, auto loan rates will be coming down soon, credit card rates will be coming down soon, or even US Treasury rates will be coming down soon, the Federal Reserve does not control these, which means by the Fed lowering rates, it may not have any impact or may not have as much impact on your interest rates as you're hoping for. Why is that though? And most importantly, what does influence those interest rates the most? First, let's look at what they actually do control, starting with this one, the federal funds rate. This is what people are talking about when they say the Fed is raising or lowering interest rates. You can see from about the 40s through the 80s, the Fed was on average raising rates. And then from 1980 through about 2020, the Federal Reserve was on average lowering rates. If we zoom in just on what has happened since 2022, when the Fed started raising interest rates, they then held them steady and then since have lowered them slightly. The effective federal funds rate right now is 4.22%. And this federal funds rate is a range that they try and make sure the federal funds rate stays between. This is not an interest rate that matters for you and I. This is the rate that banks get paid on their cash when they lend to each other in overnight markets. That's it. Has nothing to do with T-bills or treasuries or auto loans or mortgages even. And in order to make sure that this rate stays in between the range that they want it to, they will directly intervene in this overnight market. And if banks place their reserves with the Fed themselves, the Fed will just pay that interest rate to the banks by printing it into existence themselves. We are going to come back to this later because it's important, but currently there's about $3.2 trillion in bank reserves that banks are just holding at the Fed and getting the Fed funds rate directly from the Federal Reserve themselves. So this is a market that the Federal Reserve just outright controls. But it is not the only tool the Federal Reserve uses for monetary policy, and sometimes it's not the most effective either. That brings us to the second most powerful tool the Fed uses, which is their balance sheet. You can see currently the Fed has a balance sheet worth about $6.5 trillion, significantly lower than where it was when it peaked in 2022 at almost $9 trillion. You can think of the Fed's balance sheet like a brokerage account. They create money out of thin air, use that new money to buy assets from the open market like US Treasuries and mortgage-backed securities and place those assets on their balance sheet. When that accumulation is happening, in other words, they are doing buying of assets, their balance sheet is growing. During times like this, it is called quantitative easing. Now, quantitative easing is a very important way to describe what they are doing. So remember that because it's quantitative, not qualitative. We're going to come back to that in a moment. Now, the opposite is true as well. When the balance sheet is declining, they're doing something called quantitative tightening, which means assets are leaving their balance sheet. This happens from general bleed off when assets get paid back, but they do it in an orderly fashion. So sometimes they do have to roll over, sometimes they have to buy more, but overall the assets on their balance sheet are declining. This means cash is being extracted, liquidity reserves being extracted from the financial system. Since it goes back to the Fed itself, that money just gets destroyed. It ceases to exist. So QE, add cash, take out assets. QT, both the assets and the cash cease to exist. Now that's important because it's not that these assets are just getting sold back and then into the market, being traded around between other people. This is debt that's getting paid off. Dollars are lent into existence, which means when that debt gets paid off, both the asset and the money ceases to exist. The wonders of the fiat financial system. Now, depending on the scale in which they're doing quantitative easing or tightening, this can have huge impacts on the market. But again, it's not directly controlling interest rates. For example, if the Federal Reserve decides to go out there and buy $100 billion worth of treasuries over the course of a couple of years, it's not really going to move the markets at all. Yes, it's a little extra buying pressure, so prices of bonds will be a little bit higher than they would be otherwise, but not much. On the flip side though, when the Fed goes out and buys $5 trillion worth of treasuries from 2020 through 2022, that's going to have a huge impact on the market, and that's going to push interest rates down. That's going to have a big impact on lifting the prices of those bonds. But keep in mind here, this is called quantitative easing because they're making a decision based on how many bonds to buy or sell, how much liquidity to inject or extract from the market. They are not saying we want interest rates for this specific bond to be exactly here, and so we will buy or sell whatever is necessary to make that happen. They're just saying, hey, we're going to buy $1 trillion worth of treasuries or $1 billion worth of treasuries or sell $100 billion worth of treasuries, and the rest of the market forces are also going to be at play and will determine what the interest rate or the yield ends up being. Now, if you notice this chart, the Federal Reserve has been doing quantitative tightening for a couple of years now. Their balance sheet has been declining, which has been sucking liquidity out of the financial system. Over that time period, on average, interest rates have risen, but recently rates have been falling. Even the 10-year Treasury yield is much lower than where it was a couple of months ago. This despite the fact that their balance sheet is still declining over that period of time. So if they're extracting liquidity, how is it that rates are falling? Especially because we just went over the fact that them cutting interest rates is only cutting interest rates for what banks get paid on their overnight reserves. Well, there's two things at play here. One of them is front running, and the other one is what's known as the crowding out effect. To understand this first, let's take a look at this chart, which is called the reverse repo facility at the Federal Reserve. Now, the reverse repo facility is where banks can give extra cash to the Federal Reserve in exchange for collateral that they need, and they get paid a nice little interest rate on it while the cash sits there. If that sounds similar to bank reserves getting paid an overnight reserve balance at the Fed, you're right. It does. But after all the money printing that took place in 2020 and 2021, banks needed a place to park the cash and get the collateral they needed, and that all flooded into the reverse repo facility because the Federal Reserve was paying a risk-free interest rate of 5% to banks just to hold all this cash with the Fed. This meant that all of that cash was literally parked, hidden, taken, shielded, held on to by the Federal Reserve on purpose because the Fed didn't want all of that cash being flooded out into the marketplace. The Fed was trying to raise interest rates. The Fed is trying to tighten. The Fed was trying to make sure inflation didn't get out of control. So they were telling banks, hey, don't go lend this out to people for cheap. Keep it here and we will reward you for making sure nobody else can get access to this money. Sounds a little twisted. It is. Welcome to the world of the fiat financial system. This is what's known as the crowding out effect. Usually we talk about it from the standpoint of like treasuries, but it stands in this case as well. If the Federal Reserve can print money into existence and they're saying risk-free will give you 5% on your money, then financial institutions are going to do a lot of that. They're not going to put that money out in the marketplace for, 6% or 7% and take on a ton of extra risk. And they're definitely not going to take on extra risk to loan that money out to somebody else for less than 5%. But the opposite of this is also true. When the Fed does start to lower interest rates, that means that you no longer have access to that really high interest rate on risk-free money anymore. So you got to take that and you got to deploy it elsewhere. When you push this to its extreme, let's say you can't get anything over 0.5% from the Federal Reserve, all of the cash leaves that and goes out to find somewhere else to deploy it, which means now you have a lot of lenders competing for borrowers, which pushes interest rates across the curve down. And that's part of the reason why we've seen long-term interest rates start to fall recently because of front-running this, with financial institutions largely anticipating the Federal Reserve lowering interest rates over the next year or so. Big money wants to get in front of that and lock in some of the high rates now. For example, right now you can get T-bills for over 4%, when you're looking at 4 weeks or 6 weeks, but go out to like a year and you're looking at like 3.5%. You might think, well, why wouldn't you just put it in a 4-week or a 6-week T-bill and just continue to roll it over? It's because the market expects that by the time you get to a half a year from now or a full year from now, the Fed will have lowered interest rates. And so big money is willing to lock up their funds for a longer period of time right now, which puts a bid on treasury prices, which pushes yields lower because they're willing to lock their money up for a lower interest rate right now with the anticipation that over the course of that entire lifetime of that bond, that will actually end up being a higher yield for them than if they took the short-term bonds and just had to continually roll them over. If that doesn't make sense, let's say you could get 10% in the first year, but 1% every year after that for like 50 years, or you could get 5% every single year, lock that in for 50 years. Clearly, it would be better to get 5% every year, lock that in for 50 years, than to get a higher rate in the beginning and then a much lower rate for the rest of the term. That's what's going on here. But we have another big problem at play, and that is a $38 trillion elephant in the room. Interest costs alone above $1 trillion per year, the deficit spiraling out of control as they borrow more and more every year just to cover the regular expenses. No spending is off limits, nothing is getting cut, everything is getting increased. They have to borrow more and more every year just to keep the current debt pile, let alone borrowing more and more every year to finance all of the additional spending. This is why the Federal Reserve will have to start doing QE again, because the market will need somebody else to come in and be the buyer of these bonds. The reason why the market will need this is because as the US government borrows and spends, that is new money coming into existence. That is how debt works in a fiat financial system. When you go and borrow money, you are not transferring dollars from one bank account to another bank account. Dollars are lent into existence. So when you have a government that is spending $2 trillion every year, more than they are taking in taxes, that means there's $2 trillion a year of new money that didn't exist before that is being added to the money supply. This bids up the prices of goods and services. And within a short period of time, I think this will become clear to the market that inflation will be taking back off again as a result of this government spending that cannot do anything but spiral further out of control. And buyers are not going to want to hold on to treasuries at 3 to 4% anymore. They'll only be willing to lend to the government if they can get a higher rate of return, something that at least compensates them for the inflation that is expected during that time period. Now, the reason why I think this is going to happen is because this is exactly what happened last time the US hit 120% debt to GDP ratio. At the peak from World War II, the United States government's debt had reached 120% of the value of GDP, and we are there again. This makes it very difficult to get the spending back under control unless the Federal Reserve comes in to your rescue. And that's exactly what they did from 1942 through 1951, something called yield curve control. Now, this is fundamentally different than quantitative easing. I described to you earlier why it's called quantitative easing. It's because the Fed just decides, hey, we're going to be buying $100 billion worth of treasuries or $200 billion worth of treasuries, and whatever the price or the yield of the rate ends up being, we're fine with that. We're buying a specific quantity. With yield curve control, the Fed goes out there and says, we want the 2-year treasury to be exactly 3%, or we want the 10-year treasury to be exactly 4%, or 3%, or 2%, whatever it is. You get the point. They say, we are going to peg a specific interest rate, a specific yield across the curve, which means that no matter how much we have to buy or sell, we will do that. And they then use their balance sheet to control all government yields, just like they control the federal funds rate. Remember, with the federal funds rate, this is the rate that banks pay each other when borrowing and lending reserve balances to each other overnight. And in order to make sure it stays there, they themselves pay an interest rate on those reserve balances that banks hold at the Fed. So they outright control this. And with yield curve control, they then outright control the rest of the curve. Now, the 10-year treasury yield is important because most interest rates look at the 10-year treasury yield as the benchmark. Most people don't hold on to mortgages for 30 years. Most mortgages get paid off early from the home being sold. Many auto loans are getting up there from 6 to 7 to 8 years now. Business loans as well are near 10. And so the 10-year treasury yield serves as a good benchmark for the risk-free rate, which means if I can give my money to the government for 10 years for 3.5%, but I can loan my money to you for the same time period for 7 or 8 or 9%, then I just look at the risk and think, okay, well, if the risk is worth it, then sure, I will do that. But I'm definitely not going to loan my money to you for only 3% because I can just give it to the government instead. And they have a monopoly on violence to ensure that I will get my interest and principal back, whereas you in the free market do not. Which means that even if the Federal Reserve steps in with yield curve control and we see government treasury yields plummet as a result because the Fed just goes on a buying spree and they buy any and all treasuries necessary in order to make sure the government has the low interest rates that they need to support their spending. It does not necessarily mean it will translate over to mortgages over to auto loans, credit cards, or other forms of debt. Because if the government is doing that, the expansion of the money supply will only be that much faster, which means inflation will only be that much higher. And so as long as there's some free market influence on mortgage rates or on auto loans, then we could actually see an inverse correlation where the more the Federal Reserve tries to control interest rates for the US government, the more the opposite will happen for interest rates for everybody else. Now, it's always possible that the federal government comes in and they say, okay, interest rates for mortgages cannot exceed this. Interest rates for credit cards cannot exceed this. That is always possible, especially with the command and control economy that we live in today. Being surprised basically every week now with new news articles and stories about what the government is doing in order to try and control the economy instead of just letting the free market do what it does best, which is create prosperity and abundance for everybody. But power-hungry interventionists will always find ways to intervene because they think they know better than you do. In summary, the Federal Reserve controls the shortest end right now, and that has some influence on other interest rates. But the more that they exert control over government interest rates through buying up treasuries, through QE or yield curve control, means that in all likelihood, other interest rates will go up unless they start to intervene there as well. As always, thank you so much for watching. Have a great day.